Hello and welcome to the first edition of Institute for Supply Management's LinkedIn Live series, recapping the ISM report on business. We hope that you'll join us here on each release day to get the key takeaways on the data straight from the sources. And those are the chairs of our Manufacturing and Services Business Survey Committees. My name is Dan Zeiger. I'm a senior writer and copy editor for Inside Supply Management Magazine, which is ISM's member publication. Thanks for joining us today. And we'll break down what was an interesting set of manufacturing PMI numbers for January. The next 30 minutes can be an interactive experience. If you have a question, feel free to put it in the chat feature and we'll try to get to them as time allows. The composite index, it registered 49.1%. That beat a lot of analysts' expectations and was the 15th straight month of contraction, but this may be one of those instances where direction is a little bit more important than location. And I know that our chair of the ISM Manufacturing Business Survey Committee has a lot to say about it. Let me introduce Tim Fiore. And Tim, obviously there was an interesting set of numbers, as I said. Just what were some of the key takeaways from your chair?
Yeah, for sure. Yeah. Thanks, Dan. And thanks for hosting this. So for those listeners, we're in a transition here. We used to have a different platform to provide more detailed video and audio results of the PMI reports available to us. Up until the end of November, I think it was, we lost access to that platform for reasons other than our own. And so we're now launching our own. So this is, if you want to understand a deeper dive beyond what's out there in the media, and you want to hear directly from the guys who do the analysis and the report outs, that's what this forum is. We're doing it live and we'll post it up for people to have access to it whenever they want. Thanks for having an interest in the PMI. So back to Dan's question here. Wow, what a month. I would never have predicted this. For those of you who follow the report outs and have followed Manufacturing Talk Radio, which is now obsolete, and the Bloomberg activity, I've been saying that I really think that we're going to see a grow out passing the 50 point probably in March, and that we've been in the trough since August, September of last year, meaning that we were bottomed out. And the big question now is when are we going to start to grow? Well, with Chairman Powell announcing in mid-December, right around the same time that we released our forecast, that interest rates will probably not climb outside of any really unusual event beyond where they are in 2024, and that will probably start rate cuts in 2024. That was usually positive to the manufacturing community in terms of eliminating risk, understanding what it's going to cost them to refinance their own debt, better understand what it's going to cost them to invest in additional capital, as well as additional working capital. So, I've kind of felt it was going to take 2 to 3 months to start to see it happen. I still kind of feel that way, but we've seen an uptick here nonetheless. We got very close to 50. 49.1 is a really good PMI number. We are 15 months into a contracting cycle on the PMI, manufacturing PMI. If you look at the last 20 years, these things generally have run 6 to 9 months. About half the time manufacturing contracts, the overall economy contracts too. It's about half. So not every time manufacturing contracts, the economy contracts. In this particular case, we never really contracted strong. And a strong contraction is a 43. Anything south of 45, for those of you who follow me, I watch that 45 number. I really do it as a caution, a yellow light. But the red light is really 43. If you're contracting at 43 or less, that's a signal that, okay, things are going to come down to a not great ending. But we never really got there. So here we are. The Fed has said we're topped out. We'll probably drop rates. That kind of eliminates the number one uncertainty in all of manufacturing, and that is, okay, what's my future demand going to look like? Am I going to have to spend more of my resources on interest expense? Am I going to have access to be able to refinance my debt? Do I really want to expand my capacity when I don't know whether demand is going to and when demand is going to come back? So Chairman Powell kind of answered that question in December. And I don't know that he's backpedaling now, but he's kind of tiptoeing a little bit because he doesn't want to be overly enthusiastic. And I get that. And I'm trying not to be overly enthusiastic either, but I'm looking at the facts. And the facts for this month at a 49.1 are the fundamentals are really good. And that's what the purpose of this call is all about. So let's talk about that. I look at it in 3 ways. I look at it from the standpoint of demand. I look at the standpoint of output, and inputs. And you can take all the 10 sub-indexes in the manufacturing PMI and put them into one of those 3 buckets. And they have a relationship to each other. So let's talk about demand first. Many of you have listened to me in the past. Without demand, you don't have much. Well, we've just gone through 15 months of no demand. And we've been burning up all of our backlog. And depending on what industry sector you're in and who you are in that industry, you may not even have any backlog left anymore. All that backlog was there because of over ordering that occurred during the pandemic cycles. Prices went up, lead times got shoved out, people got delivered short, material delivered late. You had to stay in the queue. You over ordered. Your forecast is maybe for 100. I used to work a desk, so you told your seller, look, I got 110. This way, you got a little contingency. You add that up across all of your customers, and next thing you know, you've over ordered. The electronics guys complained about that from the beginning, that a whole bunch of this stuff is over ordering. In fact, it was, and they are hurt the most. They're still suffering from the over ordering environment. It's starting to get better, but it's been very slow. But so demand, you get the new order number, and that goes right into the PMI. It's one of the 5 elements that goes in the PMI. But also you get the new export order number, which supports new orders. You've got the customer inventory number, which is a reflection of our panelists' perception of how much of their customer has of their inventory. So you're kind of doing a look forward saying, my customer's got enough of what I make, or my customer has too little than what I make, or too much. So that's a very important parameter. The third one, new export orders. I don't know if I mentioned this. This is my 5th interview, so sometimes I repeat myself.
Yeah.
Sorry about that.
Yeah.
And the last one is backlog. The backlog is a net result of output, new demand coming in, and what are you left with at the end of the month in terms of stuff to work on without any new orders coming. That backlog number hit 60 something during the pandemic. We've been down 16 months. We're down in the 40s. We actually hit into the 30s, I think. We're now sitting at 45. So let's talk about the 4. New order number, the raw number was 48.5. The seasonal adjustment number, 52.5. That's a strong seasonal factor, but very typical for January. January is a very weak new order placement number. So you're trying to make sure that this number has relevance across all 12 monthly data points. So, okay, fine. But if you look at that new order number in conjunction with the customer inventory number, now it's starting to make a little bit more sense, meaning that, hey, I've now determined that my customers don't have enough of my product. It's on the too low side. It's actually on the high end of way too low. So that's a good thing. So now I'm expecting more new orders to come from my customers. And sure enough, there they were. They showed up. So I think that confirms the fact that we have a fundamental change in demand. We have signs of a fundamental change in demand. It's domestic driven because the new export orders are very weak. And the belief is that they will stay weak for quite some time. That's primarily Europe and China. And, but we got through the month with a stable output, new orders increasing, customers having, too little of my inventory, backlog stayed about the same. It's in the same range, within a point. Okay, I don't think backlog is going to get above 50 probably until Q2. It'll be the last of the 4 demand indicators to actually move because it's the result of other activity. It's a result of production output and the result of new orders coming in. The net result is backlog. But okay, backlog is very important. But if you understand where it's going, you have a 2 or 3 month period of expanding new order levels, and you have production levels that are relatively constant. I don't expect those to spike up at all. We're probably looking at production in the 50 to 52 range for the next 3 or 4 months. So backlog will start to grow again. And that's good from the standpoint of assurance that you're making investments at the right time, the right place. Okay, so demand was good for the month, the best demand month that we've had in quite some time. But we need February and really March to verify that because we got headwinds here on the new order number based on seasonal factors, but we'll see.
Yeah. Let's drill down a little bit on that. I know, as you know, the customer inventories index is a question. There's an index that we get a lot of questions about. I know you do too. And, technically people look at that number, it's below 50, it's in contraction. They think, oh, well, that might be a bad thing. Well, a lot of times it's not. Could you just elaborate on that a little bit more? And one of the things that was interesting, you spoke about it earlier, didn't get a lot of help from overseas in terms of demand. The new export orders index continued to sag a little bit or be sluggish a little bit. Just talk about that as well and how encouraging that is, to show how the strength of the U.S. economy, that, the new orders was that good despite little help from, say, China or Europe.
Yeah, we've been seesawing a bit on the new export orders, but generally it's been contracting and, moderately contracting. It's not strongly contracting, really. Well, this 45.2, we're in that gray zone of strong versus moderate. The panelists really see that this is not, it's going to be a headwind for probably another 3 or 4 months. The China PMI came in again last night at 49. It's probably been running under 50 for a good year. And that's not a good thing for China. German PMI is, I think, 44. So, two huge manufacturing countries are contracting, and they're not. And if China's saying 49, it probably really means 42. So, having done business in China, but so it's not doing well at all. So, but it's 15 to 18% of U.S. manufacturing output. So it can make a difference, positive or negative, more on the positive side. So we have to kind of offset it on domestic. So I don't see any help coming from the export markets. They've got domestic consumption issues themselves. They generally tend to run a little bit slower than us anyway. In terms of labor and all that, we have the right to work kind of environment here where you can let people go. There's no contracts. In Europe, people operate on employment contracts. You try to do a headcount reduction in Europe, it takes you 2 years. In China, when you hire somebody, you hire them for life. So you have to negotiate your way out of that. So I don't see the export markets as helping us at all. It's never really driven us anyway. So for me, it's kind of just upside. In the meantime, it's headwinds, and we're going to have to push our way through it. And, hopefully by the second half of the year, we'll see the export markets kind of reopen up again. And I think that kind of fits right. So let's get to the customer inventory number. So not all of our panelists respond to this because many of them don't really have the visibility, but the ones who do have the visibility have some feel for the amount of inventory that their customers are holding of their product. So if you ship 10 units this week to your customer, he's converted 8. There's 2 sitting in inventory. The people who respond to that metric have an idea of how much. Is it 2? Is it 3? Is it 4? And they say it's about right. It's too high, too low. So now they're coming in, they're saying it's too low. At a 43.7, that's too low. I mean, that's good. So for me, that's good because it means, our customers of our panelists want more of our product, which means we need to either ship it from inventory, and you can see our manufacturing inventory number, which includes finished goods, is way low. It's not like we got the inventory kicking around, or you have to make it, which is good. And you got to make it, it's probably supported by a new order that comes in. And even if you have to ship it, a new order is going to come in. So the lower that number is, the happier I am. And I don't think I've ever seen it where it was so low that it limited our panelists' customers' output. There's no way I could tell that anyway. So if I'm kind of looking at this thing, the lower the customer inventory number is, the happier I am. The higher it is, the less happy I am because it means they've got too much in the channel, which means I got to cut back on my output. So if I'm a panelist company.
Yeah. Well, let's kind of segue. You had mentioned, things look on track to, potentially for the manufacturing sector to be in expansion sometime this spring. And you had mentioned earlier today in one of your earlier interviews that there are still a couple of things that, need to happen. One of those is in employment, still in contraction. And you had mentioned that sometimes that's not a bad thing either, because companies have been right-sizing their staffs to, comport with demand. And you had mentioned on a call earlier today, well, yeah, there may be good signs that demand is coming back, but that doesn't mean companies are going to stampede to, bring back workers by the hundreds. It's going to be a gradual process. So just elaborate on that a little bit.
Sure.
Yeah.
So on the output side, our production number was 50.1, which really says it was the same as December. Okay, that's good. I mean, what would be really good is to see a 51 or 52, see some growth, but that's okay. I mean, I'm fine with staying the same because I don't think anybody was planning for growth yet. The growth spurt in manufacturing is really expected to be the second half. When we did our survey, our forecast, we said that half one of 2024 would be very similar to half two of 2023, with a little bit of more positive. We'll be growing into half two. We really felt half two of 2024 was going to be a definite, clearly an expansion cycle. So we also thought that this first half of 2024 would be a bit lumpy. So it could be lumpy for sure. Mm-hmm. But in any event, the production rates, which is almost a surrogate for billings, were very similar to December. So which kind of protects the profitability of our panelist companies, which in the end, that's what you want. As long as they can meet plan, and usually plan means I'm breaking even or I'm profitable. I mean, plan is not, I'm going to lose a ton of money. Those are hard landing environments. Mm-hmm. In the environment that we're in, meeting plan is, being constant or growing. So we met plan, I think, at a 50.1. And at the same time, we continued to de-staff. So this de-staffing should have probably happened in Q4 of last year. It definitely did happen. In our forecast, we said that we actually eliminated 2.2% of our headcount in the last 6 months of 2023. Wow, we did that stealthily without a lot of noise. When we did our forecast, we asked for an update on 23. The panel came back and said, we cut our headcount 2.2% in the last 6 months of 2023. And what you're seeing here is a continuation of that de-staffing activity. Not a big surprise for January. These are probably reserves that were taken in December, and now you're releasing the people into the market. And in January, we've had a reduction in the quits rates a bit. We've had an increase in retirements, which you generally do see in the January timeframe. Happens in December. People retire at the end of the year. So you got that dynamic going on. And so we ended up with a 47.1 unemployment. I think that's good because I think we're still carrying a few more headcount than we need for the next 6 months. And the whole argument had been for 2022 and 23 is you work so hard to get those people on board, you want to cut them loose so easily. Well, look, we all know you go and hire 100 people, there's probably 80 that you want to keep. There's probably 20 you don't. So we probably have that going on. We have a culling of the workforce, eliminating either the unnecessary activity for the future or the people who are, the bottom 10% of the performers. And that's a good thing because, in the end, the panelist companies have to be profitable. They're for-profit companies. Nobody's going to invest in a company that's not making money. So, and you're not going to make money if you're carrying headcount that's too much. And at this point, nobody's going to say, I'm going to hold on to those people for 6 months because 6 months from now I'll need them. Unless you got a special project you can put them on, like building a new factory or putting a new production line in place, and you have to divert people to do that. You're going to let them go, and that's what's happening. And in this case, layoffs were still used at about 45% of the actions were layoff actions. It was really layoff and attrition, and we hadn't really seen. We saw layoffs used extensively in December, and we saw them used extensively in May. And outside of those periods, we've been de-staffing since May, and most of it's been through attrition. Somebody quits, you don't replace them, or hiring freezes. I'm freezing all new hires. Everything's frozen. So I think the output side is good. We're maintaining a respectable level of revenue consistent with the end of last year because December was very consistent with November. And we're continuing to reduce headcount, which means that we're going to be more profitable as we enter Q2. So now the question will be, how many more people do we have to add in the second half of the year?
Right. The prices index was a number that got a lot of attention today. It went into expansion for the first time in 8 months, I believe, if memory serves. You had made clear in the report that a lot of that was due, to pricing agreements for 2024 taking effect, and that usually, means a new set of prices that buyers have to deal with. But also, you had mentioned that there were also some external factors that played into that number being a little bit higher than it's been in recent months. Just discuss that a little bit.
Sure. Yeah. So a couple things. The panelist companies have been waiting for prices to drop and lead times to get back to historical trough levels. They never got there. I think in the September, October timeframe, we all kind of gave up on them getting there. The commodity markets are still running 20, 25% higher than 2019, and they're historical levels. But and that's even with increased utilization on factories compared to 12 months ago. So absent a hard landing, they're not going to budge. Lead time, same thing. Lead times are stubbornly stuck. I get a lot of comments that lead times are coming down, that sellers are much more willing to talk and negotiate. Absolutely. In the last 12 months, we've gone from none of that to a lot of that. We came from a take or pay, no cancel, no defer order situation with your sellers to okay, let's be more flexible on this, which is all good. But, the pricing structure is probably about where we're going to be. Don't see any reason for it to drop anymore, especially with demand starting to come back. This is the problem between a hard landing and a soft landing. With a hard landing, you see prices collapse like a big V. We saw that during the pandemic, although it didn't last long. You need something that's going to last longer. But, when people don't have any other options but to spur demand based on price reduction, then you see prices come down. But we never had that. And this is the problem with a soft landing or a flyby, touch and go, that we're not going to see those prices get down to the historical trough levels. We're not going to see lead times get down to buyer advantage lead times. So we're stuck with what we have. And I think this is the biggest issue for 2024 is the resurgence of price growth at an unacceptable level that causes the Fed to delay rate reductions. Because I don't think that anything's going to happen here because we're going to have a slow grow out. I don't see that price index going to 62, 64. I see it, going to 53 to 55. And that by itself will probably not precipitate a rate growth. But to me, the biggest issue is because we didn't tamp price inflation back down to historical 2019 levels, especially in the commodity markets, that with the recovery of demand, you got the potential of prices growing again. And are they going to grow so much that the Fed gets nervous about it and starts to do something on the rate side? That to me is the biggest risk for 2024.
Yeah. How would just kind of pulling back for a multi-month view? I remember right after our semi-annual economic forecast came out, and a great share of our business survey committee respondents were very bullish about 2024, and that, as you often pointed out, was before the Fed made its announcement in December about what interest rates could play out with this year. And then the December manufacturing PMI numbers were okay, probably a little bit better or about what was expected. And obviously this month the PMI data was exceeded expectations. Just when you kind of pull back and look at the runway, just how encouraged are you? Based on the Chairman Powell has talked about it, but obviously we have not seen action yet. That things are, that the respondents are as positive or at least optimistic, cautiously optimistic as they've been, despite, and Chairman Powell kind of seemed to tamp it down a little bit the last time I heard him speak on that, or at least, maybe they might be delayed a little bit. But just talk about, the sentiment, that you're seeing, based on, what the Fed might or might not do.
Yeah.
Or when they might do it.
That's a great question. Yeah. So, I watched the news conference yesterday with Chairman Powell. And I think what he's trying to do is he's trying to slow down the exuberance around when's the first rate cut coming.
Yeah.
And the market's looking for March. I don't know, what's magic about March. I mean, you would do that if you had to stimulate the economy. Although, right now we're restrictive. So, you really want to get to maybe not accommodative, but neutral, in balance. And he actually used the words in balance. So where is in balance? In balance is probably 4%, 3.7 to 4.2. It's in that range. In the meantime, we're still restrictive. So this is the the moving target thing. So we're still restrictive. The 6-month PCE is 2.9%. Really good. Core PCE. That's very good. The PCE all in is 2, 6-month. But if you look at the 12-month, no way, I'm sorry. I think the PCE core 6-month is 2. I think the 12-month is 2.9. So what he's really saying is, I need another 6 months of the PCE being at the month-to-month change level that we've seen in the last 6 months for me to feel really good about this. But and but the market is looking for drop rates now, so we have cheaper money to go do whatever we want to do.
Mm-hmm.
And this is the dynamic that we're kind of caught in. I think it's the moving target.
Yeah. Well, we got about a couple minutes left here. I'd just like to finish up with, a two-part thing. Anything that we haven't talked about yet that you think might be important for our viewers to know. And then, I know one thing that ISM tries to put out or convey with the report on business is like, hey, this isn't just for, economists and people that watch the stock market and whatnot. Supply managers and procurement professionals can get a lot of use out of this. So the second part of that final question is, and I know that you've sprinkled, throughout our discussion, what procurement professionals should be looking for here in the data, but just sum up the bullet points. How can, supply managers get value out of the data that we've seen this month?
Yeah. Okay. So let's finish up on the last question there about forecasting and softness. So I dig through the headline comments to ferret out how many people are optimistic about the future and not so optimistic. And we're still sitting at 27% of my headline comments are about softening. So let's be realistic here. That's down from 33, 34 in the prior 2 months. So, a little bit of a movement, but remember, this is a common analysis. It's not as quantitative as you really would want. It's a little bit more qualitative, but okay. That to me says timing hasn't quite got there. As far as the positives and not so positives, we're running at a 2.2 to 1 in January. We were 3 to 1 in December, but we were 1.2 to 1 in November. So we're seesawing a little bit, but there's clearly a feeling of more optimism going forward. And it's probably all connected with the fact that customers are still ordering. Customers don't have enough of my product. The overall general economy seems to be doing better. We're no longer all talking about where's the recession, where's the recession. It's about where's the recovery, where's the recovery. About 12% of my headline comments were around Fed interest rates. That's up from 8% in the prior month, 9% in the month of that. So this is still very similar. There's this, but the perception changed from the Fed's high interest rates, to when the Fed's rates start to come down. So the sentiment is moving towards more positive optimism, I think. So if you're a buyer working a desk and you've been arguing with your suppliers for months now around lead times and pricing structures, if you came to me with the problem and you weren't quite sure what the answer was, I would say you got to jump in, but leave yourself some flexibility to be able to renegotiate, 3 to 6 months out. Because, you don't, if you're forced to stick with something for a year, which many companies are, steel prices are a good reflection of that. You don't have much of a choice here. Demand is not going to be on your side because demand is going to improve as we get further into the year. Pricing is not going to come down. Energy prices are at the lowest level. We've got low natural gas prices here, $2 an MMBTU, and we got plastics prices on the rise. So what's causing that? It's got to be demand. It has to be. It's not plants coming out. What can help that? More plants going in. Well, there is some of that going on, but is it going to really help you this year? Probably not. Yeah. So you got reduced energy markets. You got prices still on the rise. You got demand growing. You got lead times that aren't budging. You got to act, and that would be my advice: is that take your pain. You probably have already set it up. If you're running a standard cost system, you've already put your worst case prices into standard cost. So now you're trying to manage the variance budget. Take the right decision, move on, but leave yourself some flexibility because it could very well be by the time we hit half two, there could be more demand than people are expecting.
Yeah.
You've got this huge amount of unknowns. Like I mentioned earlier, we were not able to replace I think I did this on a different call. We were not able to replace our capital. When you look at capital budgets, you got a piece that's maintenance capital. You got a piece that's investment capital. That maintenance capital is replacing stuff that's worn out that you need. We were not able to get that for 2.5 years. What used to be, call it, 12-week lead times turned out to be 24. So you got this, piece that's got to catch up to you. And, and we're also planning on expanding our production capacity in 2024. So it's not going to happen until the second half.
Right. Well, hey, Tim, this has been great. I really appreciate it. Helping me break down and helping our listeners and viewers break down the what we talked about. An interesting set of January manufacturing PMI numbers. So this was a great debut, I think, of our call, and we hope that you'll join us here for every release day for the ISM report on business. We'll do this again on Monday. I'll be talking with Anthony Nieves. He's the chair of our services business survey committee, and we'll have a lot to talk about then. But we hope you'll join us here on the first and third business days of every month, where we just get the takeaways straight from the source, the chairs of our committee. So for Tim, Fiore, and Angela Miller, who helped us a lot behind the scenes today, thanks a lot for joining us, and we'll see you next time.
Great. Hey, thanks, everybody. Appreciate it. See you in March, I guess. Right? Yeah, March. Yeah.